Hey, it's Cory Boldroff, the real estate guy. Have you been wondering if we're going to come into another 2008 crash? I get a lot of clients asking me this, a lot of real estate agents. We go through and we talk about this. I just don't think it's physically possible. I don't think it's statistically possible. So I wanted to give a little bit of a video about why we cannot come into another 2008 crash. So in 2008, we are in a completely different area than we were today. So starting in 2002, we started seeing an increase in mortgage fraud by 1,400%. So there was a lot of fraud going on in these loans. There was a lot of deregulation that happened in the banks. And they basically went on this mission to try to get everyone to become a homeowner. But in doing so, they deregulated how qualifying programs work, how they were allowed to sell into the secondary market. So that was one of the first things that actually was a key indicator of what was going to happen and kind of foreseeing that happen. Number two, the rates went from 6% down to 1.75%. And they allowed everyone to get financing, doing those 1% option arms, adjustable arms, interest only. And then all of a sudden, 2004 to 2006, the Feds increased interest rates consecutively 17 times in a row, coming from 1.75% all the way back up to 6.5%. So people's payments were doubling and tripling during this time. The NODs, they were starting to skyrocket by this time, and they were up into the millions. Every single year, 1 million people were served notices of default, meaning that they were starting the foreclosure process. Appreciations started at 10% in 2002, year over year, and climbed all the way up in California to over 25%, and sometimes those markets were going up by 50% appreciation in 1 year. 1 year. So by the time we came into the 2006, 2007, there was over 1.25 million foreclosure notices served. The subprime market started to crash. Lenders started to go out of business, and they started showing significant losses. So that's actually what spiked this crash in 2008. During this time also, there was an unprecedented amount of people accessing their equity, pulling out, maximizing their loan to value, how much they owed to how much their home was actually valued. And they're buying cars and motorhomes and going on trips and just doing all kinds of luxury items, thinking that the market was always going to be there. So that's what caused the 2008 market crash. Now, why we are nowhere close to that right now, we started to see an appreciation starting to happen in about 2013. The foreclosures were at an all-time low, and they started decreasing in the last decade. So they started decreasing at this point 19% over a 6-month period. So people started getting a better position. People's economy started doing a little bit better. The foreclosures actually went down from 800,000 to this last year was under 300,000. So there's the notice of default just aren't there just to show or indicate that we're going to come into this foreclosure short sale market, despite what news stations want to say. Also, over the last 5 years, we've had a healthy appreciation rate of about 3.5% to 5% in most markets in California. So again, the average market goes up about 3.5% over a 40-year period, year over year over. So we're right there in the norm. We're actually appreciating at a healthy rate. So I know it looks like, oh my God, but it's just we kept doing it end over end. Now, does the real estate market always cycle? Yes, it always cycles, but it always does this. 40 years ago, a house was worth this, it's worth this today. Yes, there were some bleeps in the meantime. So that's another reason why. We were actually at an all-time low and to a crisis point of people accessing their equity. There was only a 1% of people who actually went in and took money out of their bank or out of their house. And to show you that there's 50% or 61% of people owe less than 50% on their house, and 90% of people owe less than 80% on their house, meaning that we would have to come down by 20% for the majority people to be here. 61%, we would have to come down 50%. So you can see again why we're just not in the same position as we were before. As our economy was doing awesome despite this coronavirus. We were at an all-time high in work participation rate and an all-time low in unemployment rate, which are key indicators of people being able to afford stuff in the future. Interest rates have stayed low, about under 4% for the last 5 years, and they just started creeping down lower, which actually means that people can afford to buy more, not less. More people can afford to buy, and more people can afford to buy more houses. So that's why also we've seen an appreciation rate. In California, we have an inventory crisis, so it's really hard pressed to find people homes. So this is a great way to show people that we're not going to come into this crash that so many people are and news stations are trying to say. So I hope this was helpful. If you do have any questions or you want me to give a micro look at your neighborhood, your certain market, please feel free to reach out. Cory Boldroff, the real estate guy. I'm here trying to deliver good, valuable information and resources, trying to be of service to my clients and friends, family, and their friends and family. So if you like this, please share it, like it. I'll be putting this on my YouTube channel. I appreciate all your guys' help. Stay safe and healthy. God bless.